Silver made a new high today, so many of our subscribers are asking us if silver will go higher. In this video, we will answer this question by analyzing 3 sets of data because today we detected 3 unusual trades in the silver ETF SLV. Again, because if you've been following this channel, you know that we analyzed unusual trades in SLV just last week on March 28, this day, when we shared this video. The title of the video, Will Silver Rally Like Gold Next Week? And clearly it has rallied, and our options trade that we shared in the video expired today, April 5th, making us 1000% profit, 10x. So make sure to watch this video to learn how we made 10x trading unusual option activity. We will put a link up here to this video. A lot of insights you can learn from this video in hindsight. So in this video, briefly, you can see the options that we discussed right over here on the profit loss diagram. Profit of $150, and we spent $15 for each of these 23.5 strike calls expiring April 5th. So 150 profit divided by the cost of 15 times 100 for a percentage, 1000%. So let's take a deeper look at this option. Here's the option chain here for the April 5th options. At the 23 strike calls, you can see our position here. They are worth $152 to $160. So basically, we turned $15 into $150 in a week. 1000% profit, 10x. So you can imagine if we did 10 of these unusual option trades and only one of them is a winner, like this one, then we would still be net profitable with 1 win, 9 losses. Okay? Because the 9 losses would be negative 900%, while this one winner is 1000%. That's a net profit of 100%. But if you've been following our channel, you know our win rate is not 1 out of 10. It is definitely closer to 9 out of 10. All right, because we are following the trades of wealthy investors. And by doing so, we get better data because they have better information, sometimes insider information. So if you want access to more of their trades, make sure to go to our website where you can use their trades to diversify your portfolio, increase your probability of profit. All right, so what is going to happen to silver now? Let's take a look at the data today, April 5th. So on the option time and sales tape, we can see the first unusual trade here happening at the last hour, 3:25 at the 8-second mark. July 19 options, 33 strike calls, 50,000 contracts. Now, keep in mind, this trade is actually connected with another trade right here. 3:25, 8-second mark, same time. 27 strike calls. 12,500 times 2, 25,000. So what is this trade? This is a ratio here. Okay, 25,000 to 50,000, right? So when we analyze this trade, let's take a look at what this is. July 19th. We can see here at the 27 strike calls for July 19. Total volume of 26,000, greater than the open interest, so we know these are opening trades. Same on the 33 strike call. 50,000, greater than 10,000 open interest. So, what are they doing? We know there was a ratio. 27 strike call. They bought one of these, and for the 33 strike calls, they sold 2 of them. Because that ratio of 25,000 to 50,000, it's a 1 to 2. And so when we analyze this trade, you can see that this strategy is known as a back ratio strategy. And you can see that it is a bullish trade because we have a positive delta here. And you can see that based on this diagram here, the x-axis is the share price of the silver ETF. Y-axis here is profit loss. 0, if the blue or purple lines are below 0, that is a loss. If it is above, it is a profit. Okay. Blue represents the expiration date. Purple represents the current date. So you can see that as the silver ETF goes down, it is a loss. If it goes up, it is a profit. But notice that this back ratio strategy, peak profit is right here at $33. Okay. If it goes up more than 33, profit actually decreases to a point where if it does break this price here, which is around $38.60, it will actually become a loss. Okay. So this unusual trader doesn't expect silver to break $38.60. And if silver doesn't go up, their loss is not as much, okay, because it is capped to the downside. You can see how it does not slope downwards. It is basically flat. That blue line is flat. All right, limiting the losses. All right, so that is what this trade is telling us. But keep in mind, this trade, though, they are selling one of these call options naked. Okay, one of them is naked here. And so by selling these call options, it does require extra buying power. All right, and that is why we didn't want to put in that extra capital for this type of trade, because it is, in comparison to our membership trades on our website, lower probability of profit. So we simply just bought the 33 strike calls. They are very cheap. You can see just $31. This is our position here. All right, so that's the first trade. That is unusual. You can see there's a second one too. Now the second one, you can see it's happening also at the last hour. 3:35, 54-second mark. This one is for the January 17, 2025 options. 33 strike calls and the 40 strike calls. We can see here 21 1,000 of them. However, we also see this here as well. Just 2 minutes prior at 3:33, same option trades, another 21,000. And we can see here, they were buying the 33 strike calls, selling the 40 strike calls. Okay, so what does this mean? Let's take a look at the January 2025s. Here they are. 33 strike calls and the 40 strike calls. Notice how the volume for both options greater than the open interest. So we know these are opening trades. And as we mentioned, they were buying the 33 strike calls and selling the 40 strike calls. And so when we analyze this trade, you can see that this is a vertical call spread. Okay. And notice again the 33 strike calls, right? Same as that previous unusual trade that we just looked at. The 33 strike seems to be a target. Okay. Even though these options expire in 2025, notice that the purple line, which is the current date, becomes profitable immediately if silver were to just increase. Does not have to wait until the year 2025. Okay, so keep that in mind when you see options that expire a year out. That does not mean you have to hold it that long. Okay. These unusual traders trade long-term dated options because of the smaller theta decay. The theta decay on these trades are very minor. You can see here it's only negative 0.11. It's a time decay. So that reduces their risk on time decay. They are still going long here with the positive delta. All right, so that's what this trade is telling us. All right, their break even at expiration is over here at around $33.49. Okay, right here. But as we mentioned, they don't have to wait this long for this trade to be profitable. And that is why we simply just followed this trade with the same position at the 33 strike call and the 40 strike call, and just using position sizing as a way to manage the risk, because we put most of our position sizes into the trades that we share on our website, as opposed to these trades that have lower probability of profit in comparison to our membership trades. So what is going on for the third unusual option? The last but not least, we can see this happening in the morning at 9:55. We see these trades coming in. June 28, 26 strike calls and the 30 strike calls. April 26, 23 strike calls and the 26 strike calls. Okay, so they are doing these simultaneously at the same time. Okay, what are they doing? Let's take a look. April 26 options. We can see them right here. These 23 strike calls and the 26 strike calls. We believe they are closing out of these trades and using a rolling strategy where they are closing out of these trades and moving to later date of the June 28th and to a higher strike price at the 26 strike calls and the 30 strike calls for the June 28th. Okay, they were taking profits and rolling up to a higher strike price and a further date out. Okay, so that is what they were doing here. And by buying these 26 strike calls, we are also following this position as well. And again, using position sizing as a way to manage our risk. And you can see that this is also a vertical call spread. Okay. And you can see that it is a bullish long trade because of the positive delta here. Right. And for this trade, notice how its break even is actually a lot lower over here, about $26.67. Not farther out into the 33s here, like we saw in the other unusual options. Okay, but keep in mind, by getting a lower break even, it does require more, because you can see they had to pay more for this strategy, $71, okay, as opposed to $48, right? So there's a difference. If you pay more, then you get more profits earlier, okay, and less risk, because it is a lot riskier in the trade if your trade has to break even at $33 as opposed to $26. Okay, so that's what the difference is on these trades. Also, their probabilities of profit is different. If you look at the probability of profit, which is this column here, you can see that the 26 strike calls here for this to be in the money, the probability is 40.9%. Okay, and if you look at the other trades, for example, the January 2025 unusual options, you can see here that the probability of profit here for these 33 strike calls, 18.3. Okay, and that's why they're cheaper, and that's what we were explaining a little earlier, right? So that's something to keep in mind if you want to decide which trade you want to follow and how you want to trade. If there's multiple unusual options, which one works for your trading style? Because this trading style, even though it is lower probability of profit, it also costs less. You can see the potential profit is a lot more. Look at this potential profit here. Is you can make a lot more. This is, the risk to reward ratio here is a lot more. You can see the max profit here. You can see right on this box here will show the max profit on the blue line here. 652 is the max profit, right? And if you calculate 652 divided by the cost of 48 for this trade, you can see that this trade can potentially make 1,358%. Okay, a lot more than what we made today, 1,000%, right? But it is lower risk, because you can see that this one makes 329 max profit. 329 divided by the cost of 71 times 100 to get a percent is 463%, right? So that's their max profit potential on this trade. So you can see how by lowering your break-evens or probability of profits or increasing it, it also changes your risk to reward ratio. Okay, so it really depends on how you want to trade, how much risk you want to take on, and these are the things we analyze and decide when we set up our options strategies. All right. If you want to learn more, make sure to go to our website. We'll put a link here, and make sure to watch this video to learn how we made the 1000% 10x today trading silver using this type of analyses, strategies to beat the market. Please smash the like button, subscribe if you haven't. Take care and have a great weekend.